Are you tired of the anxiety that tax season brings? Much of the stress we feel around taxes isn't from the system itself, but from persistent myths and misinformation. These stories, often heard online, from friends, or based on outdated advice, can create unnecessary fear and confusion. In this empowering video, we're going to shine a light on common tax myths that cause undue stress. Our goal is to replace that confusion with crystal clear understanding, offering you the knowledge to approach your finances with confidence and peace of mind. Get ready to debunk, learn, and feel more in control of your tax journey. Tax myths thrive in an environment where financial literacy can feel daunting and personal. The intricate nature of tax codes often leads people to seek simple answers, even if those answers are incomplete or inaccurate. We tend to rely on anecdotes, half-remembered rules, or advice that might have worked for someone else in a completely different situation. This reliance on informal information creates a fertile ground for misinformation. Over time, these stories are repeated as facts, gaining momentum even when they are outdated or fundamentally flawed. It's a classic case where confidence in sharing information can unfortunately spread faster than actual accuracy, leaving many taxpayers feeling overwhelmed and misinformed. The human brain naturally seeks patterns and simple explanations, especially when faced with complex topics like taxes. This cognitive bias makes us susceptible to catchy, yet often incorrect, tax hacks or warnings. For young adults just starting their financial journey, or small business owners navigating new regulations, these myths can be particularly damaging. They can lead to poor financial decisions, missed opportunities for legitimate savings, or even unnecessary fear of the tax authorities. Understanding why these myths persist is the first step toward building a more resilient and informed approach to your personal and business finances. Let's empower ourselves with accurate knowledge. One of the most pervasive tax myths is the idea that receiving a large refund is the ultimate goal or even an expectation. Many people believe that if they don't get a refund, they've somehow failed or done something wrong. This couldn't be further from the truth, and it often leads to poor financial planning throughout the year. In reality, a tax refund simply means you overpaid your taxes during the year. It's essentially an interest-free loan you've given to the government. While a refund can feel like a bonus, it indicates that more of your hard-earned money was withheld from your paychecks or paid through estimated taxes than was necessary. For employees, your refund amount largely depends on your W-4 form, which dictates how much tax is withheld from each paycheck. For self-employed individuals and small businesses, it relates to your estimated tax payments. The goal of smart financial planning isn't a large refund, but rather to have your withholding or estimated payments closely match your actual tax liability. This means aiming to break even, or perhaps owe a small, manageable amount at tax time. This approach allows you to keep more of your money throughout the year, giving you greater control over your cash flow. You can then invest it, save it, or use it to pay down debt, rather than waiting for a lump sum once a year. It's about financial efficiency, not just a year-end surprise. Another common source of anxiety is the fear that any minor error on your tax return will trigger an immediate audit or severe penalties. This myth often paralyzes taxpayers, making them overly cautious or even hesitant to file. It's important to understand that the tax system is designed with a degree of flexibility and understanding for honest human error. Most small mistakes, such as a misplaced decimal, an incorrect calculation, or a forgotten deduction, do not lead to dire consequences. The IRS primarily focuses on significant discrepancies or patterns of noncompliance. For the vast majority of taxpayers, an honest mistake will simply result in a notice from the IRS requesting clarification or a correction. When a minor error is detected, the IRS typically sends a letter explaining the discrepancy and how to resolve it. This might involve paying a small additional amount, receiving a small refund, or simply providing more information. You'll often have the opportunity to respond, provide documentation, or file an amended return, Form 1040-X, to correct the issue. The system is designed to facilitate corrections, not to punish honest taxpayers. What truly matters is consistency and a good faith effort to comply. Proactively correcting an error once you discover it demonstrates your commitment to accuracy and can prevent any potential issues from escalating. Don't let fear of minor imperfections deter you from filing accurately and on time. Many people hear about specific deductions or credits from friends, family, or online forums and assume they automatically qualify. This leads to the myth that certain expenses are universally deductible, regardless of individual circumstances. The reality is far more nuanced, and what works for one person may not apply to another. Tax deductions and credits are highly dependent on a multitude of factors. These include your income level, your filing status, the type of income you earn, your specific expenses, and the ever-evolving tax laws. A deduction for a home office, for example, has very specific criteria that a casual remote worker might not meet, even if their friend does. General advice, without the crucial context of your personal financial situation, can be misleading and even detrimental. Relying on broad statements like, "You can always deduct business meals," or "all charitable donations are fully deductible," without understanding the specific limitations and rules can lead to errors on your return. This is particularly true for small business owners who might confuse personal expenses with legitimate business deductions. To truly benefit from deductions, it's essential to understand the specific rules that apply to your situation. This means looking beyond general advice and delving into the details, or consulting with a qualified tax professional. Empower yourself by understanding that tax planning is personal, and what's right for one person isn't necessarily right for all. This myth paints the IRS as an omnipresent, punitive entity constantly scrutinizing every taxpayer's return, actively searching for mistakes to penalize. This perception generates immense fear and anxiety, making tax season a dreaded time for many. However, the reality of how the IRS operates is far different from this common misconception. The IRS is a massive organization tasked with processing hundreds of millions of tax returns annually. Their primary function is to efficiently process these returns and ensure compliance on a broad scale. They simply do not have the resources to individually audit every single return. Most interactions with the IRS occur when information on your return doesn't match data they've received from other sources, like your employer, W-2, or banks, 1099 forms. The system is designed to prioritize efficiency and scale. The vast majority of returns are processed without any direct interaction. Audits are relatively rare, affecting only a small percentage of taxpayers each year, and they are typically triggered by specific red flags or random selection based on statistical models. These red flags often relate to unusually high deductions for a given income level, significant discrepancies, or reporting inconsistencies. The IRS's goal is to ensure fair and consistent application of tax laws, not to persecute individual taxpayers. By filing accurately and keeping good records, you significantly reduce your chances of an audit. Understanding this can greatly reduce your stress, allowing you to view the IRS as a necessary part of the financial system rather than an adversary. Navigating the world of taxes doesn't have to be a source of constant stress. A healthier, more empowering approach to tax advice begins with a critical mindset. Be cautious of absolute statements or guaranteed shortcuts that promise universal results. Tax laws are complex and highly individualized, so what works for one person may not apply to you. Always question advice that sounds too good to be true or claims to be a universal solution. Instead, seek out explanations and understanding, rather than just quick tips. Empower yourself by learning the why behind tax rules, which builds genuine financial literacy. This deeper understanding will reduce your stress far more effectively than any fleeting piece of advice ever could. To truly master your tax situation, focus on continuous learning and proactive planning. Keep meticulous records throughout the year, understand your income sources, and be aware of major life changes that could impact your taxes. For small business owners, this means diligent bookkeeping and separating business from personal finances. For young adults, it means understanding your first W-2 or 1099. If you're ever unsure, don't hesitate to consult reliable sources like the IRS website, reputable tax publications, or a qualified tax professional. Investing in professional advice can save you time, money, and immense stress in the long run. Remember, knowledge is power, and informed decisions lead to greater financial peace.